entirely ours, and I'm sure the next 25 minutes will justify that. But it's an interesting decision for a money manager to say that, hey, I'm stopping all investments. Why this case? Valuations?
Valuations, right? So the only reason why we have stopped taking money is because of valuations. So Niraj, 2020, nobody wanted to touch small caps, mid caps. Right, 10-year returns for the small cap index were negative. 3.5 years later, the small cap index is a 5-bagger. Okay, and at that point in time, you had stocks which are available below cash. Today, the small cap index, the entire index is quoting at 30 PE multiple, 3 times price to book. Internally, we have benchmarks as far as returns are concerned. Last 10.5 years, we have delivered close to 34% CAGR returns. And we want to, if we don't find opportunities where we can make 30% CAGR returns for a client, then there's no point taking money. So we don't feel that why we continue to remain very, very bullish on the India growth story. Right now, we see froth in the markets. This could probably, I don't know, this probably resembles to me like something like October 1987, right? Not to that extent, maybe we are in September or this, and this could blow up on the way up, but there are clear signs as far as froth is concerned. What we are seeing in the SME index, the SME IPO index, I think from 1500 or something has gone to 40,000 within a matter of 3-4 years. The index itself is a 20-baggers. The stocks over there are getting oversubscribed, IPOs are getting oversubscribed 400, 500 times. So clearly signs of froth. Economy is very good. We are very bullish on India. Don't get me wrong, we are not negative as far as India is concerned. Our only concern is valuations. And that's one of the reasons why we are temporarily suspended inflows.
Okay. Okay, I'll revisit this point in moments from now, but I just want to establish the kind of money manager that you are, Siddharth, and therefore that will tie in well with the thoughts that you express. So I know a little bit about you by having spoken to you, by looked at your tweets, etc. Can you tell us what kind of investment philosophy that you follow, and how does that gel in with the market mood the way it is currently?
So I think, Niraj, for us, it's a multi-bagger approach to investing.
Okay.
Right? Our portfolio itself has gone up 25x in the last 10 years. And our average holding period is more than 5x. So I would assume a lot of our holdings have become multi-baggers over a period of time. And then the Indian market itself is a multi-bagger. So it's not like, it is not there. The first criteria for us for investing is we want to buy the largest company in the worst performing sector. So look, we bought, a lot of print media. We've been talking about it a year and a half back. A couple of print media companies, because media stocks had delivered pathetic returns for a very long period of time. And both these IPOs came, I think, in 2006, 2007, around that time. For 15 odd years, they delivered negative returns. And they had nearly between 30 to 50% net cash on the balance sheet. Net of that cash, they were available at 3-4 PE multiples. Right, and if you talk about moats, these companies have serious moats. It's impossible for most of the print media companies have such a large treasury chest that it's impossible for each other to enter into another one's territory. Right, no, everybody stays clear of each other. It's like two tigers fighting. They're very, very strong moats. Right, and people said at that point in time that, excuse me. This is a dying business. Well, if it was a dying business, then during COVID, circulation had become zero. Today, circulation is back to 97% of pre-COVID levels. And we are seeing the advertisements as for, in the newspapers. The first 7-8 pages of newspapers today are full of IPO advertisements. And then with the election coming in, you're going to see governments spending also on media. So valuations are attractive. So we bought the biggest companies in the worst performing sector, right? The valuation. The second aspect, as far as our approach is concerned, is valuation. For us, narratives don't matter, valuations matter. 2020, the narrative was really, really bad as far as India is concerned. I watched television, and every fund manager who came on television said, we are losing hope as far as India is concerned. I don't want to take names, but every fund manager who came on television, and it is usually on those days the biggies who come on television, and they said we are beginning to lose hope on India. But the valuations were right at that point in time. Today the narrative around India is excellent. You can't find a flaw as far as the India story is concerned, but the valuations are not.
Got it. So since you search for value, you may buy the largest sector in the worst, or largest company in the worst sector, or thereabouts, whatever, but effectively companies which are trading at good valuations. But you're right, the narrative around India is solid. Global narrative around risk assets with the Fed likely to cut rates. Might not be negative, even if it can't be too positive from the levels that we are at. What brings the valuations to palatable levels for an investor like you then?
Time. Markets will always top out on good news. Markets will never top out on bad news. Markets will always bottom out on bad news, right? I don't know. And I'm a firm believer that all risks are outliers. So, and investing is all about the future, and I don't have a periscope where I can go and see the future, right? So how do you build in margin of safety? Only through valuations. What has happened in the history is already in the stock price. Historical news, everything is, and particularly in a bull market like this where the market is so efficient. Market is extra efficient today.
Yes.
So everything is priced in very, very quickly. All companies need to do is give their 2030 guidance, and the stock prices, discount them today itself.
Yeah, that's true. No, but Siddharth, a point that was made by some of the sell-side strategists who have been bullish now, or who have largely been bullish about 2024 on India. They're not overtly bullish. They're saying we believe a 10, 14, 15% upside on the index is in the offing, because all the risks that were risks of 2023 are receding, be it a higher crude price, be it higher interest rates, because interest rates might be higher for longer, but they'll come down from where they are right now. And growth, while the rest of the world may falter, India will falter less and will still stand out, and therefore mandi karne ka man nahi hota hai. That's the call, right? So therefore my question is, even if time brings down markets to a more reasonable valuation, are you comfortable with a number on the multiple or whatever you call it, which is 25, 30, 40% below the current numbers, or do you expect a modest correction which will give you a chance to put in money, because earnings growth will also make up for some of the exuberance currently?
So again, as I said, at a Nifty level, you might still see a 10 to 15% gain next year. Nifty is not something that has rallied quite a bit. My bigger concern, Niraj, is around what is happening in the broader markets. Right? It literally is the madness of the crowd, where you're seeing 3 or 4 QIPs getting launched every single day. Blocks happening left, right, and center. And these are happening after stocks have run up 30, 40, 50x. My question is, where was everyone when these stocks rallied in 10x, 20x, 30x? A lot of these stocks rallied. Why were you not buying then? Right? So it just is, it kind of scary to me as far as what is happening in the broader markets. The IPOs that are, this reminds me of 92, 93, 94, where you had more than 4,000 IPOs within 3 years. And then in 1998, 99, you had a Vanishing Companies Act.
We need to slip into a break. What we'll do is, when we come back, we'll try and talk a little bit about this madness of the markets, or madness of the crowds that he's talking about. But at the same time, while Siddhartha is not constructive currently, we'll try and figure out what is in his beacon, what is in his funnel, for him to latch on to at some point of time when the markets or the valuations come to reasonable levels. Stay tuned to the Portfolio Manager. This promises to be an exciting second half. I'll be right back. back with the portfolio manager in conversation with somebody who's told his investors that, hey, hang on, I do not want your money right now. And some amongst the other things that they had done is write something called Madness of the Crowds.
Yes.
Okay, so tell us what this is about.
So I think what we're doing is we're putting out a daily one-page newsletter. As a part of our daily this, we go through all the corporate announcements and news. And my team was a little frustrated that we don't find anything worthwhile in what we are doing, right? Because the valuations are out of whack. So I said, let's do this. Let's find out where you see madness. And it's kind of, we're finding a lot of those stories. So every day we're going to put it out. And this might continue for a while. I'll be honest with you, right? So the thing about this is that, as Keen said, markets can be irrational for longer than you can stay solvent. So whether it's a bull market or whether it's a bear market, it will tend to surprise you on the upside more than what you expect. It goes beyond rationality. It goes into irrational exuberance. And a bull market sucks everyone in.
That's true.
And a bear market forces even the best of the guys to throw in the towel.
That's true. That's true. We certainly are in a bull run for now. Siddhartha, okay, so before I get to, like I said, the funnel, by the way, so is the 1 crore market cap company getting into multiple things the most insane thing that you've read in a while, or is there something even wilder?
No, it's been crazy. It's every single day has been crazy. Today, Niraj, companies are raising more money by doing a QIP overnight. And you have to understand these QIPs get subscribed in 2 or 3 days. We run a fund. And it beats me that how can you do a research on a company in 3 or 4 days? And if you had done a research, then why had you not bought it earlier? So companies today are raising more money. A company recently raised 1,000 crores through QIP. It's into rails. And the combined profitability for the previous 10 years is negative 100 crores. They've lost 100 crores over the last 10 years. The promoters were buying the stock at 50 rupees, 70 rupees, 100 rupees. And they're selling it to the public at 1,000 rupees. Why would they want to run their operations? They're making more money through stock market operations.
But Siddhartha, the argument that some of these businesses which have had a very checkered past, be it railways, be it defense, etc., is that they all make that if you look at our past 10 years, you will never be able to foretell what is going to happen in the next 10 years, which are very exciting things. And everybody in this space, defense, railways, etc., tends to make the same argument. And to an extent, I'm not talking about the valuation, but to an extent, what the next 5-7 years of railways will show at large will be materially different and better than what the last 10 years have shown, right?
See, my worry, again, as I said, Niraj, is we're going to do very well as far as infrastructure. I was one of the first ones to be bullish on infrastructure.
Right.
I've been bullish for the last 4 or 5 years. But the point is some of these stocks are already discounting the growth for the next 10 years.
Got it.
And there is no scope for any surprises. You could have commodity prices going up. You could have an incident like what happened in the tunnel where somebody got stuck. Or recently there was a blast at one of the companies. So it does not factor in any margin of safety. They're priced to perfection. Any bad news could really hit the stocks.
Got it. Okay, so then so now I'm presuming that you've stopped taking investments. You would largely be not too sanguine on the prospects of the markets in the very near term, but an investor like you would keep things on radar for when the tide turns and the valuations become palatable. There would be growth stories that you would be inclined to bet on at that level. I'm not getting to the level on the index or the small cap index or whatever it is, but I'm just trying to understand where are the stories? Kahani kahan pe achhi hai? What is it that you like the most?
I like everything, and our thesis remains the same, which we talked in our previous interviews, which is B2B businesses, which is infrastructure, which is capital goods. Right? These are stocks and sectors which haven't, again, railways or defense. I'm saying these are stocks and sectors which are going to do really, really well over a period of time. So money is going to flow from the B2C segment to the B2B segment. Bank credit is going to flow over there. Power sector. All these sectors are going to do well. We were one of the first ones to have invested in these sectors way back in 2019, 2020. And we still continue to hold them. look, for us, these stocks have gone up 15x, 20x. So no complaints. Even if there's a drawdown of 25, 30%, I have no problem, because if I sell, my taxation implications are much higher. So yes, these are the sectors which will continue to do well. Coming to when and how the opportunities come in, I don't see, I don't know. You take a call at that point in time. I don't have a crystal ball, so I can't forecast the future. So we'll wait for that point in time. As of now, these stories look good. And look at it. It is Coal India which has done well. It is NTPC which has done well. It is Larsen and Toubro, Mahindra and Mahindra. Nobody is talking about these stocks.
That's true.
These were unpopular stocks, which is PFC, REC, right? And we bought truckloads of PFC and REC 12, 14 months back. And not in my imagination would I have thought that these stocks are going to become 4 baggers within 1 year.
That's true. Well, yeah. So, well, kudos, and in some sense, good luck as well that it's worked out so well for you. So, good stuff. But surely there is some stuff, Siddharth, which might be doing decent business, but is out of fancy currently. I'm not saying you're going out and buying them right now, but what are those pockets? I mean, there might be, like you said, media, right? I mean, you talked about media, that you've invested there. The stocks may have, I don't know when you invested, but the stocks may be higher from when you bought as well. But still, they are not expensive in the truest of senses, right? So tell us the theory, if not the timing about this. So for example, you bought into media. You've not bought into media just because they have cash and they have moat. That they have held for the last so many years. Why the timing is the question I want to get into.
The timing typically comes from the contrarian approach.
Okay.
Contrarian is when you can go and publicly tell people that I'm buying this stock and nobody even shows an interest in that. So
but there has to be a business case, right?
The business case was there, right? The business case was there that they had the largest download, you know, Dainik Bhaskar, DB Corp, has the largest downloaded app in the country, digital app in the country. They've expensed out all the money in developing the app and they have not even monetized it. So when they monetize it, it's going to be a double whammy. The expenses are not going to be there because the expenses have already been incurred, and everything is going to flow to the
bottom line. Yeah.
So these are very, very strong businesses, and when you actually go and realize that somebody like Bombay Samachar has a 1,500 crore, 2,000 crore treasury. It's a small Gujarat-based newspaper. Do you think anyone in their minds will go and launch a newspaper there? Because it's going to be they have the money to fight with you for the next 10, 15, 20 years. So is the case with a Dainik Bhaskar or a Dainik Jagran. Or a Times of India for that matter in Bombay. Everybody's tried. Nobody. These are serious moats.
That's true. But so you are saying, but this was the case even 3 years back or 4 years back, right? The stocks haven't really done too much. You believe that they might now start doing, you're not timing it as to when they will start. The valuation is in your favor, so you've invested?
Typically, yes. See, there are times where you have to wait 2, 3 years, 4 years.
Okay, you don't mind that?
I don't mind that.
Okay.
The thing, Niraj, is everybody wants to buy when the cycle is going to go up, and nobody knows when the cycle is going to go up.
Okay.
And when the cycle goes up, it's a frenzy. Who's been able to buy small caps in the last 4 or 5 years? For the first 2 years, people were only waiting for a correction to come.
That's true. That's true. A lot of people are skeptical about putting money to work in IT services. To an extent in pharma, though I hear the last 6-9 months there have been some bold moves into pharmaceuticals as well. But these are two export-oriented sectors. If the world markets are going to go slow, likely that the businesses might be soft. But tried and tested businesses, etc. Do these fit the bill of neglected sectors wherein you can buy the leaders or not quite?
See, honestly, these are very large sectors, right? And they're very well researched, priced to perfection. So right now we don't have any investments in pharma and IT. Again, great companies, but I'm not here to admire great companies. I'm here to make money. So I would buy into a good company, and all the companies that we have invested in, I would say they are very good companies. It's just that when we bought them, they were completely out of favor. If today I talk to anyone about APAR Industries, nobody says anything about that. But for 7, 8, 10 years, people questioned it. With price comes conviction. Even my own conviction.
Okay. Anything that you may have, again, I don't want to get into specific names, but anything that you might have invested into recently. And again, I'm not saying that means that it's good to buy, but I'm just trying to understand how you've thought about businesses when you've bought them.
So typically we bought a couple of tire stocks 2 quarters back.
Okay.
Right?
The rationale being?
The valuations were very reasonable. Okay. Crude prices had started coming off. The auto sector itself is doing really, really well. And the valuations were reasonable. And auto sector is doing well. Interest rates are off. Demand is very strong. We don't see any spare capacity as far as the tire industry is concerned. So whatever the industry is practically operating at 95% capacity, and no major capacity is coming up over the next 18 months. So typically that when that happens, pricing power is with the companies. The companies have pricing power. So that's where we invested. We invested in a couple of print media companies, as I told you, more than a year back. We invested into PFC REC, 12, 15 months back. But we don't make a lot of new additions.
Got it. Got it. Last couple of questions. The last one will be about what you are reading, right? But before that, your position market-wide is known. Where is it that you are the most skeptical, Siddharth? Wherein the street may be bullish, but that's fine. And even if the street is not bullish, that's okay. But where is it that you believe that either the valuations have run too far ahead of themselves, or that the business case has changed from what it may have been in the recent past, and therefore there might be troubles ahead?
There are a lot of places. But I think large caps at this point in time are the safest.
Okay.
I see serious trouble brewing in the SME space.
Okay.
See, it's become a lottery space where IPOs are getting oversubscribed 150, 200 times. And typically, I know the journey of a first-time investor. I've been a first-time investor, and for me, more than anyone else, I remember. Typically, you apply for 10, 15 IPOs. You don't get right. And then you hear stories about your friends doubling their money. And then you throw in the towel and you start buying them in the secondary market. And then after some time, your IPO stocks that you'd apply to go below their IPO price. Then you buy an average. And typically you see a 5, 7, 8, 10 year right? This is a typical IPO market kind of this. And this time it's happening in a lot more in the SME segment. We're talking about, the small cap index. It's gone a 5x. It's nearly 500% from a 8,700 bottom in March 2020 to 43,000. I don't think so. Profitability is increased at that rate. Profitability would probably not have even doubled. So we've seen massive expansion as far as P multiples are concerned.
Got it. Okay.
So these are two areas. IPO market is again something which the valuations, nobody reads DRHP in bull markets.
But thematically, anything? I mean, because small caps is a very wide bucket. There might be good companies there too. I mean, you might have some very good companies in the small cap space.
See, we own them. But are we going to buy them at these levels?
Okay,
no.
Got it.
Because I need margin of safety for buying.
Right. Sure.
They might do well over a period of time. These are very well-run companies. But I would, and as he said, my stomach is full. I arrived early to the buffet, and I ate my fill. If anyone wants to enjoy the party, they can.
Yeah, perfect. Okay, Siddharth, before we wrap up this conversation, would be lovely again to try and understand what do you read, because I believe you read a lot.
Yeah.
Right. You get your family to read a lot as well, from what I know. So, what is it that you like reading? What is it that you've read recently which you would be comfortable recommending?
So I read this book. I'm reading less of finance right now and more of. Okay, Niraj, before this, what I'll tell is what I just told my new team members last week. In a bull market, read books about bear markets. And in bear markets, read books about stock picking. So if you really want to read the go-go years. Okay, read 1929, A Crash at this point in time. I would recommend people reading The Robber Barons. And what you're going to see is a perfect replication of what is happening. In the go-go years, the same thing. Companies were acquiring companies at lower PE multiples so that their valuations could get bumped up, which is what you're seeing is happening with Varun Beverages, right? They acquired a company at 0.7 times market cap to sales, and the market is hoping that it'll get up assigned 11, 12 times market cap to sales, which is the same thing. History tends to repeat itself, or rather it doesn't repeat itself, but it rhymes. Because human psychology, human behavior doesn't change.
All right. Fantastic. We've got some great nuggets, Siddharth. Thank you so much for joining our studio. It's the first time we're talking face to face.
Lovely to be here with you, Niraj. I really enjoy chatting with you.
Thank you. And the pleasure was entirely yours. I can safely tell you that, Siddharth. Thanks for the nuggets of wisdom, and thanks for joining on the Portfolio Manager.
Thank you. Bye-bye.
And viewers, thanks for tuning into this episode.